Okay, in today's video we're going to make a start on financial ratios. So we've been looking at the three key financial statements: the balance sheet, income statement and cash flow statement. And financial ratios are a means to look at those statements, pull out key information from those statements and make some determinations about how this particular business is going in a number of key areas. Okay, and today we'll just introduce ratios and then have a look at liquidity, the first of those key ratios. Okay, so ratios can be used by internal or external stakeholders, so those within the business or those outside the business. So outside could be shareholders, for example, or within obviously could be senior management or employees who are trying to make decisions or understand the business better from a different financial perspective. In order to make those effective decisions, however, you need to be able to compare those ratios to different time periods, to industry averages, or with other similar businesses in operating in a similar field. And that's what ratios are really done for, is to make a determination or a calculation and then to make a comparison against one of those key areas. And then it may be potentially up to the business to employ some strategies to improve the business so that it ultimately improves that ratio. And that's what the last part of the finance course is, about financial strategies. Okay, so we've got four different types of ratios. We'll focus on liquidity today, but the next three videos will go on with the other areas of ratios. So liquidity, as we've discussed in class, is the ability to meet a business to meet its short-term commitments. So really it's about a business's ability to meet its short-term liabilities. Gearing is effectively ability to meet debts in the long term, so it's really about the solvency of a business. Profitability, is this business profitable? What's its gross profit like? What's its net profit like? And what sort of decisions can be made in relation to those two key figures. And then efficiency is both the efficiency to extract a certain level of output from that business, but also how effectively is it, for example, collecting its outstanding accounts receivable. Okay, so in terms of liquidity, like I said, is the ability to meet a business to meet its short-term obligations. So that would be its current liabilities in effect, although other things such as wages, utility costs need to be considered as well. And those current liabilities would be met from current assets, so cash, stock and accounts receivable. So does the business have enough of that cash, stock and accounts receivable to effectively meet its current liabilities of its accounts payable and overdraft, really? But then also, does it have enough cash, for example, to pay its wages, to pay the electricity bill that arrived last week, to pay the superannuation balances of its staff, for example? The ability to meet those short-term obligations is critical for business, and it really can make or break it. Because if a business can't pay the staff wages, for example, that are due next week, or it's 3 months behind on its superannuation payments to its staff, this business is facing a critical juncture and may not be able to survive in the long term. Okay, so the liquidity ratio or current ratio is measured by current assets divided by current liabilities. Not surprisingly, given what I was just talking about, that it really is the ability of a business to meet its liabilities with its assets. In terms of what's considered an effective liquidity ratio or effective current ratio, there's a rule of thumb of 2 to 1. So $2 of current assets to every dollar of current liabilities. And that means that business has appropriate current assets, cash, stock and accounts receivable, to be able to meet its current liabilities. Generally it's accounts payable and any outstanding overdrafts. Now that figure sometimes is considered that a lower figure would be acceptable, mainly because some businesses more businesses are adopting just-in-time inventory management, which means they don't need to hold as much stock and they won't have as many liabilities to meet in the short term. So just a point there, although businesses need suitable current assets to pay off their current liabilities, on the other side of the coin, if a business has too high a current ratio, so it's 12 to 1 for example, that business has really got too much cash in there and it's not effectively investing that cash back into the business. So while a 2 to 1 ratio is considered acceptable, if a business is much higher than that, it would actually be considered to be an inefficient business, because it's giving up, there's an opportunity cost there of that money could be used more appropriately for the business and for the business to grow. Now, liquidity is sometimes also referred to as working capital. It's the working capital ratio and the current ratio of the same thing. But working capital is your current assets minus your current liabilities. So what's the difference between your current assets and your current liabilities? Like the ratio, business wants to have a clear difference between its current assets and current liabilities. So at least as many current assets as its current liabilities, and therefore it wants to have a positive working capital position. That's it for liquidity, and the next video will deal with gearing.